What is margin for trading oil futures? Imagine controlling a large amount of oil with just a small amount of money. That's what margin allows you to do in oil futures trading. When you trade oil futures, you don't buy the physical barrels of oil. Instead, you agree to buy or sell oil at a set price on a future date. To open this kind of trade, you need to deposit a certain amount of money with your broker. This deposit is called the margin. Think of it as a good faith deposit that shows you're serious and able to meet your future obligations. There are two key types of margin in oil futures trading. The first is the initial margin. This is the minimum amount you must put down to open a trade. It varies depending on the contract size, and the exchange but is usually a small percentage of the total value. For example, a standard crude oil futures contract might requiring an initial margin of around $3,000. The second is the maintenance margin. This is the minimum balance you need to keep in your account to keep your position open. If your account balance drops below this level because of market movements, you'll get a margin call. That means you must add more funds to avoid having your position closed automatically. Margins in oil futures are typically between 3 and 12% of the total contract value. So, if a futures contract is worth around $60,000, the margin might be between $1,800 and $7,200. This small percentage gives traders leverage, meaning they can control a large amount of oil with less money. But remember, leverage works both ways. If oil prices move against your position, your losses can be much bigger than your initial margin. Using margin in oil futures is a way to participate in the energy commodities market without physically handling barrels of oil. It is useful for hedging against fuel price changes or speculating on future oil prices. However, because of the leverage involved, it's important to monitor your account closely. Market volatility can cause margin requirements to change quickly, especially during times of high price swings. Always stay aware of your broker's rules and the exchange's regulations to avoid surprises. In short, margin in trading oil futures is the performance fund you deposit to open and maintain your position. It allows access to large market movements with a relatively small investment but also requires careful risk management. Understanding how margins work helps you make smarter decisions and stay in control of your trading activities.